Good afternoon, ladies and gentlemen. A very warm welcome back on Business Today Television. We are on 1st of September. 9 months have lapsed as far as 2025 has been concerned. It's a year which has left with a lot of challenges as far as markets are concerned. Lots of issues that have come up, put equities on the back foot. FI net selling is huge in the month of August alone. We have $5.1 billion worth of Indian equities being sold by foreign funds. In the month of July, this was 5.4 billion, and they have been consistent sellers earlier as well. Against this backdrop, we have a great macro, good monsoons, lower inflation, lower interest costs, higher disposable income and whatnot. But markets continue to come under the impact of tariffs which have been imposed by the US to the extent of 50% on Indian merchandise exports. Where are the markets headed? How will this festival season pan out? What should be done in terms of stock picking? We are now joined by Mr. Trideep Bhattacharya. He is the Chief Investment Officer for Equities at Edelweiss AMC and the man behind the superstar fund Edelweiss Midcap. A very warm welcome to you, Trideep ji, and as always, it's a pleasure to host you. Tell us to good afternoon. Tell us to our viewers, Trideep ji, what do you think of sentiment at this point in time as far as Dalal Street is concerned? Lots of positives and an equally long list of negatives.
True, and that's why we call the markets being at fair value. But behind that conclusion, let me sort of take you through the way I see the markets right now, which will obviously kind of lead us to think how it might shape up going forward. So I think at the moment India is going through, or in the last quarter, I may say, of about 1.5 years of earnings downgrade cycle. This period actually started around about April, May, June last year, when we entered into the national elections timeframe. Decision making practically stalled, and likewise, what we saw in that case is earnings estimates started coming down. If you look at FY25, we have seen practically no growth in FY25, even though we started by estimating close to about 15% growth. This year's, as you were pointing out, additional challenge has been the tariffs and in the Trump era, and that's something that we've had to contend with. And that's the reason, if you look at over the last 1.5 years, we have been in the middle of an earnings downgrade cycle. However, if you look at going forward, a few things are changing. One is the fact that oil price has come down close to about 20-25%, which is meaningful. Inflation is down again meaningfully. Government on the fiscal side has come up with meaningful measures looking to boost consumption, which all in all of these are lining up to hopefully better times from an earnings upgrade point of view. The issue that you and I have to debate and understand and internalize is this earnings upgrades will come through post-Diwali, post the festive season, whereas markets are at levels which broadly factor a lot of, some of these are close to September 24 highs, and we have it 2 or 3 months before earnings estimates make a comeback. So this time gap is what I would call as a time correction time in the markets. With markets around fair value, will probably be in plus minus 5% range in the near term, after which the earnings upgrade cycle will hopefully start, and that will truly bring better times for Indian markets over a period of time. So in a nutshell, that's my markets hypothesis right now, where we are and where we are likely to be headed in the next 12 to 18 months.
Right. With that background in mind, now let's shift our focus and attention to Edelweiss Midcap. Trideep, as I have mentioned earlier in our conversations with you, this is a fund that's probably the lightning rod, the flagship of your AMC, a superstar category fund, very, very good set of returns, consistent performance, and of course, very, very good stock picking. At this point of time, Trideep, what is the thought process in your mind post first quarter earnings. We've seen markets have corrected. We've seen earnings in mid caps, at least some of your portfolio stocks doing pretty well. Lots of government based incentives coming into the economy, which will also be helpful to your stock picks. At this point of time, how does the mid cap universe of 81 stocks in Edelweiss Midcap look to you?
Fairly positive, fairly optimistic. I would say that two bits. One is I'll make two comments. One is midcap as a category. Second, as the 81 stocks that you were referring to. I would say midcap as a category is one of the sort of lesser appreciated categories in the sense for its growth rates. If you look at last 12 to 18 months, and analyze the earnings downgrades and where it has materialized, it is not that difficult to find out that majority of the downgrades have come through in the large caps and the small caps, whereas mid cap as a category have been the better category in terms of holding up of earnings is concerned. This is what we have been long believers in. And as followers of earnings upgrades, this is something that we kind of reflect in our portfolios as well. In a nutshell, we want to hold those stocks where, in absolute terms or in relative terms, the earnings upgrades stack out better than the broader population. That, I must say, mid-cap as a category held up quite well. And within mid-cap as a category, the stocks that we have held through over the last 12 to 18 months in terms of earnings upgrades have held through quite better on a relative basis when times were tough, and or in certain sectors in absolute terms as well. So net balance, if you look at my portfolio, I would say that we expect over the next 12 to 18 months about 15 to 17% earnings growth for our portfolio as a whole. And against that, if you look at what we are paying for, is round about slightly more premium than that. So net from a P, what we are paying for versus what we are getting in terms
Yeah.
of growth, I would say the next 12 to 18 months look quite good from a return point of view, from an earnings growth standpoint.
Okay. Now, ladies and gentlemen, let's look at some excellent data that we've collected on Edelweiss Midcap. Firstly, I'll request the PCR to show us the returns that this fund has come up with as far as since its setup is there in December 2007. So this is a return, ladies and gentlemen, of the regular scheme, because in 2007 that was what was available. This is a 10,000 rupee SIP that we've calculated over a period of 17 years. In all, you gave Edelweiss Midcap over so many years 20 lakh 40,000 rupees, and the fund management team turned it into 1 crore 48 lakh rupees. That's a stunning 21% CAGR return over a span of about 17 years. Now come to the direct scheme, which was launched in January of 2013. Again a 10,000 rupee SIP. In all 14 lakh 40,000 rupees is what the SIP initial amount was, and that is a stunning 60 lakhs. Remember, the return percentage is higher for two reasons. The mid-cap rally started over the last 5-7 years, and more importantly, the direct route helps you put in more money compared with the regular scheme. And this, ladies and gentlemen, is the wonderful performance. In particular, please pay attention to the rank within category. Look at the last three columns: 10-year ranked third, 7-year ranked second, and 5 years ranked second. This is consistency, and this is the delivery that Edelweiss has done over a CAGR period of 10, 7 and 5 years, and handsomely beaten not only the category itself but also the index. To remember, the mid-cap index has been an animal when it comes to delivering annual returns, and Edelweiss Midcap has beaten that as well. Trideep ji, this is your performance and it's fantastic. Now tell us, at this level, do you find midcaps attractive? Can this rate of CAGR return continue over the next 5-7 years?
Yes. If your horizon is anywhere between 5 to 10 years, I see no problem with the category. In fact, I would go ahead and say that mid-cap is probably the sweet spot of India as a market over the medium to long term. Some of the best growth categories which are gaining market share in economic terms in the context of Indian economy. Like, for example, sectors like hotels or hospitals or capital markets, those underpenetrated segments within the Indian economy are reasonably well represented in the mid cap as a category. And that's what makes me feel that the growth drivers within this segment are quite robust, particularly if you are looking in the 5 to 10 year horizon, and is positioned quite well to deliver wealth creation for investors.
Okay. Trideep ji, I was just looking through a lot of reading material on Edelweiss Midcap Fund, and at this point of time, are there any outsized sectoral bets that the fund is keen to take? The macro, as you mentioned, is really good in terms of PLI schemes, in terms of GST rejig that is about to happen. Interest rates have been cut. There is money in the hands of consumers, great monsoon. So, any outsized bets that you have in mind?
Sure. So I think one of the things that we have been betting on for a good 6 9 months right now and gradually building position is in the consumption domain. We have been, if you look at the consumption domain and divide it into three parts, the luxury consumption, the mass consumption, and the rural consumption. We started off being positive on luxury consumption and rural consumption and have actually ramped up our bets on mass consumption as well. So net, if you look at our portfolios, that's one sector that we are reasonably overweight on, and we think all the drivers that you mentioned, including GST cuts, the tax cuts that came earlier in the year, and also monsoons, and along with interest rate cuts, hold up quite well for consumption as a domain. The second area where we are quite constructive are overall NBFCs in the context of financials. We think that as rate cuts stand to happen, um, with valuations being reasonable, we think that is one segment which will continue to hold up relatively better, and I think could give us outsized returns overall. Barring these two segments, there are niches that we are positive on. We are quite positive on hospitals. We are quite positive on hotels as a segment. And of course, the sector has rallied. But defense is a third area, is a final niche area that we are positive on. Though there, I would say, given that the stocks have rallied quite well, maybe near term one would be a little more careful. But overall, all these sectors are something that the fund is overweight on. And we think that if you look at next 3 to 5 years, these are the areas which will generate supernormal earnings growth, first of all, versus the broader market. And that should translate into hopefully better returns for investors in this fund.
Fair point. So, that's how it is, ladies and gentlemen. Uh, Local consumption in the form of luxury, mass, and rural, NBFCs because of the rate cut, and of course, hospitals, hotels, and defense. That is the state of play as far as the portfolio is concerned. Trideep ji, capex has been something that mid cap companies have outperformed their large cap counterparts, and that has also played out very well in the Edelweiss Midcap portfolio. Is there a capex related theme that you are aggressive on, maybe power?
Yes. So what we think overall that will stand to happen is the government capex part of the story will actually come into gear after almost about year and a half of policy hiatus. The reason I didn't want to bring that up as a segment is this time around government capex would be fairly concentrated in certain areas, which could be defense, which could be power, or which could be railways. So they then tend to become more stock specific, but certain elements of government capex is certainly we are positive on. In the name of capex, I must admit that we think private capex is still some time away, and hence we probably have to wait maybe till next fiscal year before we start to see any signs of pickup there. So selective, I would say, is what we are betting on in the form of government capex.
And what is it that you are staying away from? What do you don't like at all?
commodity-related sectors. So basically, whether it's oil and gas or metals and mining, or for that matter, utilities, a lot of these commodity-related sectors are something that we run meaningful underweight in, and that's basically funding the overweights, which I mentioned earlier.
Okay, fine. And how about a view on gold and silver? Just as you came in today on our show, a record high on silver. It's topped 1.23 lakh rupees per kilo, and gold now at 1.4 lakh rupees, 1.04 lakh rupees a tola. How do you see this as something which is competing for SIP money? I mean, this is something that has given stellar returns, predictable and secular returns, and we all know Indians love gold.
So I would put something like this: that I'm not an expert on gold. I'm more an equities guy rather than commodities. But as an observer, here are my two bits. I think, given tariff-related environment across the globe, we are probably heading for inflationary times. And in inflationary times, two asset classes, in my opinion, will hold good for investors over the medium term. One is equities, because when earnings estimates start to come through, when earnings upgrades start to come through, the best inflation hedge known to mankind is equities. And the second would be precious metals, including gold and silver, particularly when things are not going great, when there are earnings downgrades or there is uncertainty around the world. This is one segment which, in my opinion, will hold up relatively better off. So, while one is not giving a directional view on precious metals, I think in the asset allocation for investors who are listening onto this show, the allocation towards these two asset classes, which are equities and precious metals, should certainly be higher on a structural basis than what it has been in the last 5 years.
Okay. And what about this real estate theme in conjunction with the cement space, Trideep ji? Uh, Rate cuts galore. Of course, real estate prices haven't corrected as they should have, but a view on the real estate space plus cement.
So broadly neutral plus is the way I would put it. So slightly positive, but broadly neutral, because I think the real estate cycle is now 4 to 5 years old. So we have seen strong growth rates coming out of builders, which are direct plays on real estate. Overall, happen in the context of markets for a good while. I think going forward, it'll be more the ancillary sectors which might see a better sort of better days in the form of growth and earnings. And it's probably more mid-cycle than early cycle overall is what I would call as real estate. Cement, a lot of it depends on private sector capex. I think that is still some time away, and hence I said that those two segments would be mostly neutral for us in the context of our portfolios.
Trideep ji, you have a presence of Midcap IT in your portfolio, in particular 2, 3 stocks which have been multi-baggers over the last 5, 7 years. But overall, large cap IT has been a bugbear. It's been a disappointment. Valuations now are at 5-year, 7-year lows in frontline IT stocks. Do they make an investment case given debt free balance sheets, given quality managements? Yes, they have missed the AI bus, that's true. लेकिन यहाँ से क्या?
So I think clearly there is a valuation catch up that might stand to happen in some of the large cap IT names, and we are in not in a mid cap fund but in some of the other funds. We are positioned to play that valuation catch up because clearly at the moment a lot of concerns driven by United States and also how the recent numbers have been, and if particularly if rate cuts stand to happen in the United States, we would see in the near term beneficiary being an IT services sector and certainly some of the names that you mentioned. But overall, within the segment, our idea of owning those stocks are the ones which have valuations, but at the same time some growth to offer. That's the reason some of the mid-cap IT names still make the cut, and some of the larger names actually don't. While they have valuations, I think structurally growth has been lacking. I think for wealth creation, a mix of both are needed. And that's the reason, relatively, we are more constructive on some of the mid-cap IT names, even though valuations are probably slightly on the higher side.
Okay, fair point. And how do you explain this conundrum of, rising tariffs, the world's oldest democracy fighting with the world's largest democracy, 25 years of hard work between two nations put to the sword. How do you see this India-US relationship impacting markets for the better or for the worse?
I think it's basically market cycles is how I would put it. If you elongate the horizon of about 50 to 70 years, we have seen the best benefits of globalization behind us. And we are now increasingly moving towards a more protectionist world across the globe, United States being the latest player in the same. What this will lead to is a multipolar world where democracies or economies will align with themselves in terms of partnerships. Net it will be negative for global trade. Net it will be negative for valuation multiples. But we will learn to live in this overall in the context of our growth rates. It will certainly shy off a few percentage of global growth looked at it from a longer period of time, because that will be eaten away by inflation. Essentially, all this protectionism, depending on whosoever does it, not just the United States, would lead to higher inflation, and that will come out of consumption pocket. So net, a more inflationary world, lesser global trade. But given that India is predominantly a domestic-linked economy, with more than 2/3 of the economy of GDP coming from domestic earnings, we think we will sail through this fairly decently over the medium term. Near term, there could be some disruption, which I think both of these economies will try to keep it to the minimum.
Right. On this very somber note, Trideep ji, here's wishing you all the best, and looking forward to this continuing outstanding performance from Edelweiss Midcap. There used to be a poet by the same name as mine, and he wrote 4 or 5 very wonderful poems, a paragraph which I present to you. ये गम के और 4 दिन, सितम के और 4 दिन, ये दिन भी जाएंगे गुजर, गुजर गए 1000 दिन, कभी तो होगी इस चमन पे बहार की नज़र, अगर कहीं है स्वर्ग तो उतार ला ज़मीन पर. So with these wonderful thoughts, we bid you goodbye, and we hope to have you back again soon.
Thank you very much. Thank you for your kind words. We will certainly try our best to keep this up.
Well, that, ladies and gentlemen, was Trideep Bhattacharya, the man responsible for this stunning returns on Edelweiss Midcap Fund. It makes outsized sectoral bets, is keen on power, defense, NBFCs because of rate cuts, and of course the domestic consumption basket, whether it's via luxury, via mass, or via rural consumption. Thank you for watching. Stay tuned on Business Today Television. There's a lot that's happening in the market, a nice dark shade of green today. Thank you for watching.
Hello and welcome. You're watching